Hello everyone, I'm Dr. Stock, and in this video we are talking about what's going on with the markets and that jobs report coming up on Friday. I think it's worth our attention, and we'll take a look at the market, see where they're at right now as of today's close, and look at to see possibly where they go Thursday and possibly where they take us by Friday. And this will close out the week for us when we get to Friday, leading us up to that big old week for the CPI. So we'll see if jobs sets us up for a pretty good start to that, or if it's something that makes us a little bit more fearful about what's to come from the Fed. That's all in this video. Check out this offer from Moo. It is absolutely awesome. You get access to it through using my link down in the description. Not only are you supporting yourself by signing up for this trading app, depositing money absolutely free. You get up to 17 free stocks by doing so, and it helps to support this channel. When you deposit $100 or more, you get 7 free stocks, including 2 AI draws and 5 other stocks valued up to $2,000. And then also, if you deposit $1,000 or more, you get 17 free stocks, all 17 of them, including still those 2 AI draws, and then still 15 other stocks valued up to $2,000. Take advantage. Incredible opportunity available through my link down in the description. One other thing, take a look down in the description for the link for my Patreon to hear more of my commentary, see my Patreon exclusive content, and get access to my private Discord to interact with me and my community members. Click that link. That's down in the description. With that said, I'm Dr. Stock, Doctor of Education. Let's get right into the content. All right, so check this out. On February, on February the 8th, we got the non-farm payroll jobs report coming in 517,000, which was way over, about 2.5 times what was expected. With the rising federal funds rate and with inflation running like it was, we expected a big slowdown, and instead, well, you can see what we got. This enormous bar that's right here, which is almost as high as it was back in July of 2022, and we saw this weakening trend, and all of a sudden, boom, pops right up. Now, I think a lot of that could be people just needing jobs, and January is a great time to start, and we'll see if that persists through February. February is sitting right around that 200,000-ish level for consensus. So we'll see if we come in a lot cooler, something that brings us back in line more with what we saw trending through November and December, going into that February report, which comes out on Friday. When we look at Friday, March 10th, you can see 8:30 a.m. non-farm payrolls. You can see the previous 517,000. Consensus is coming in right around 205,000, and Trading Economics forecast that at about 210,000. So if we look back, let's go back in here, take a look at the charts here. That puts us, that's below what we had in December. Now, there were upward revisions that took place to previous month. I think 71,000 more jobs than what they expected. That I think that goes back to November, December, or maybe it was just December, but still, that means that January could also be revised up from what it was before. I don't think that's as impactful as what we see from February. So we want to see what that looks like in the markets as that comes in. And also don't forget that that puts further pressure on the CPI and PPI reports if it comes in hot like January did. So we have compounded issues here, plus that impending FOMC meeting March 21st and 22nd, along with their new summer of economic projections. This is a really super critical time, and I think that we have to be paying attention to it, especially if we're playing the markets. And if you're any traders that are out there that are looking for up or down to happen over the next short while, this is definitely something to pay attention to. All right, so here we're looking at the SPY, which tracks the S&P, and you can see the run that we made going all the way back to October the 13th. This is the daily chart that we're looking at, and it was a pretty good run up. And then we got to February 8th, which is this candle right here, which reversed that little bit of a trend that we saw going. We had a nice strong candle before that, possibly continuing to run up, and then all of a sudden, that was more than we expected. And at the time, a tight labor market could be something that signaled that the economy was running too hot, that inflation was going to persist. And then, well, you could see what happened even the next day, that we started to doubt even more, and then we hit a little bit of a bottom at that point in time. So this is all that led up to the CPI report that we got. Be like, okay, well, inflation's moderating. Maybe it's okay. Maybe we persist with a tight labor market. Inflation still moderates. It comes down eventually. We're good. And then that takes us all the way up to February the 14th, when we did not get love from the CPI on Valentine's Day. That came in 0.5% month over month and 0.4% month over month for CPI for all items, and then for core CPI. And I was actually surprised that the market actually did okay with that for at least a little bit of time, until we got The PPI reading coming out also to be at 0.7, and then the market was like, okay, maybe we're not so good. Maybe inflation's running hotter than expected. PCE came out at the end of that month and was also a little bit more confirmatory, so that takes us down through here. Consumer sentiment also have an inflation rating near term. Inflation rating is also moving up. So the narrative changed from there. Okay, well, we're going to have to wait and see. We're going to have to watch what happens. Maybe January was a one-off. Maybe it was seasonal adjustment. So a lot of speculation, a lot of uncertainty. And so we get this weird sideways-ish, upbeat, downy trading that we've been getting more recently. And look where we closed today in the markets. So we closed right at the 50-day, and we tried to drop below it a little bit. However, for the SPY, it held out this time. So it could be that we have that hold out through Thursday. It could be that we don't move much off of that on Thursday. And then Friday, when that jobs report comes out, we could either see it go one of two directions. So at this point, it's a coin flip in time. It could be one of those things that if we're still near the 50-day, that it could be the thing that drops us down. Let me see, 398 down to 392. So that's about 1.5. If we go down here, that's about 2% down from where it's at right now. So downside, I think a high number for jobs, depending on what sort of number. If it's anything like January, I think we're down to the 200-day in the SPY. So that'd be giving up about 2% from where it closed today. So that would be on Friday that we see that sort of weakness closing in. And then that also leads to fear for the CPI. So if we saw an even bigger reaction, at least we would have some reason why. But like I said, I think down 2% would be that downside case that we get a hot jobs number coming out for non-farm payrolls on Friday. Now, to the upside from there, I think with the CPI coming up ahead, I think 404, so that's 6, it's about 1.5% up is what we could see from a good jobs number. And it really depends on the market. If they are overzealous about that and they're like, woo, February did cool off a little bit. Things aren't as bad. The labor market, not as rampant as we thought. So labor conditions, not completely horribly tight like we thought. Maybe January really was a one-off. Maybe that also gives us a little bit of insight into what to expect inflation-wise for February. So maybe the CPI and PPI are going to come in a little bit more moderate, a little bit lower than they were. The market could have that sort of euphoria. So like I said, from where it's at right now, from where it closed, about 1.5% up, possibly we get up to 408. So that would be about 2.5% up between Thursday and Friday. That's a big jump. So we have about 2% down to 2.5% up, and that's a fairly wide range. I think honestly 2% down, I think we'd have a downward bias because there's a lot of fear and uncertainty going on right now, and about that inflation running even hotter for longer than what we expect, and that January is going to repeat itself. And I think jobs could be the beginning of that precipitous event where it would just be one thing right after another. So I know I've gone on a little bit about this, but I have a lot of thoughts. I want to share the perspective with you guys because it really is nuanced. And I want you to understand where I'm coming from when I talk about where I think the market's going to go in the near term. Now, breaking up above this little tiny peak that we have here that we failed and dropped right back down to the top of these candles to 404. We're currently under 4,000 in the S&P as of today's close. That can be resistance for us. That means tomorrow, maybe another red day. Maybe we continue to follow out this pattern that we see with this gravestone doji that's right here that we just keep on dropping down from where it's at. So we're going to have to watch and see if the 50-day holds out of support or if we have a little bit of a fearish day tomorrow in the markets. And then, like I said, leading up to Friday, 8:30, that's really going to be the decider. So Friday, March 10th, 8:30 a.m., that'll tell us if we close red or green for Friday. Those are my thoughts about the SPY. Let's take a quick look at the Qs. No real commentary there other than the price movement because I shared my commentary for you. Don't pay too much attention to that blue line. That I don't think we even get to that unless the CPI and PPI both come out. Well, CPI I think would be that day, March 14th. That's the day I think that we could possibly make it back up there if we get a super good read. I'm talking like 0.3, 0.2. I think the market would go absolutely nuts and it would be a very strong positive day to watch inflation come down so much cooler than what we saw in January. But I'll make my own CPI video because I know that this one's getting long. I do want to just continue talking about where I see the markets going according to the jobs report. So we close, let me see, 297. So we're just under that 300 mark. Not so bad. And we could possibly revisit these peaks, which would be about 1% up and maybe up to this top peak that we have here where we hit resistance before. So we wanted 2% to gain, in my opinion, from a good jobs report, not necessarily a great jobs report. Yeah, I think if we came in a lot lower, if we came in a lot weaker, possibly we had some bonus points to that top side. But 1 to 2% I think is about right from where it sits right now to where we could possibly see it go by Friday. I think, again, CPI hanging over us, inflation reports hanging over us for the following week. I think it holds back on some of that euphoria. That 200-day held is pretty strong report for us. My goodness, strong support for us before in the markets. And I think that that's going to hold out through pretty much any jobs report that we would get, unless it's a complete repeat of January. Then possibly we see a little bit more weakness coming out of fear, not only for jobs, labor market being too tight, but also what it could mean for inflation numbers also repeating themselves or getting worse than what we saw in January. So assuming that we don't get surprised, and I don't think that we get surprised, we're going to have to watch that part of it. But if we do get something that's still a very strong number, much higher than expected, maybe then we see that 200-day, which is about 2.5-ish, 2 2.3% down from where we're at right now. So about this jobs report coming up on Friday, I don't think that it will be a repeat of what we saw in January. I hope I'm not wrong about that. I think it's going to come in much softer. I don't know if it hits expectations, if it hits consensus, or if we come in possibly maybe slightly above consensus. But as far as going 2.5 times consensus, I don't know that I see that happening. It might. Who am I to say? Now, for the market impacts, however, I think I've covered that pretty well, that we could see several percent move in the S&P and in the Qs, and you can go back and look at those percentages. It's much easier when I have the charts in front of me to remember the numbers that I said. I know 1 to 2% up with the Qs, and then up to 2.5%, 2 2/3% down. That would be if we get a fairly negative number. Again, a lot of it, I think some of the response that we get from the jobs report is going to be held back by whatever we get from the inflation reports the following week, because I think that's the more important of the two, and I think that's why people care at all about having that tight labor market, which should be good for the economy. If we need a lot of jobs, if there's a lot of job openings, a lot of people need to get to work and low unemployment, that all sounds good, except for where inflation's concerned, and that's the part that's really going to rattle the markets, because that really means a more hawkish Fed. That's what I have for you in this video. I hope that you enjoyed my commentary. If you did, check out that link for the Patreon down in the description. Click sign up. See my Patreon exclusive content. I'm coming out with more of it all the time. And also don't forget about the community that I have over there through the private Discord, where you get to interact with me and the Patreon members in the community that are over there already. Also, don't forget about your free stocks by clicking that link for Moo, signing up, and depositing your money. Not only are you supporting yourself, so you have returns coming back to you at absolutely no cost. You're giving free stuff, but it also does help to support this channel as well, and allows me to come to you more often with the information that I find helpful in the markets that you can use to help inform your decisions and move yourselves forward financially. With that said, I am Dr. Stock, Doctor of Education. We'll see you in the next video.